Investor's Guide on ET Now. That's the show you're watching. Now, we've got a lot of emails from you of late talking about your insurance plans, the fact that you bought ULIPs 3, 4, 5 years ago. Now they're really expensive. When you're looking at them, especially in these market conditions, you realize that they're worth a lot lower than your initial investment to begin with. So there's that big question. How do you basically figure out whether you should be pulling your money out of a ULIP, whether you should continue investing in a ULIP, or should you just keep the money there and start an investment elsewhere? To answer all of that, Anil Sehgal, who's an insurance expert, joins us on this show to answer some of the questions. So Satyarul Nagraj has written in, Anil. He tells us he began investing in MetLife Smart Plus 4 years ago. Now that's a ULIP with a premium, he tells us, of 40,000 rupees a year. Now he's been getting negative returns from this investment, and he tells us he's been thinking about surrendering the policy, but he's been told if he surrenders the policy, and he's invested 1.8 lakh rupees so far, he'll only receive about 1.5 lakh rupees, which is less than the money that he put in. So he wants to know, should he surrender that policy, or should he switch maybe from the accelerator to a multiplier, and that's basically just two modes of investment within that same ULIP. What should he do on it?
Nagaraj, your question is very valid. The fact of the matter is that equity values currently across the markets have come down significantly. And you're caught in a situation where your fund value is currently lower than your total investment over the last 4 years. To my mind, given the fact that you have invested in a long-term product and the fact that current valuations are fairly low, I think you should continue to make that investment. Continue with your policy. You will have the advantage of making further investments at lower valuations, and therefore the opportunity to benefit when the equity markets do recover. Additionally, if you do continue to invest, then over time the surrender penalties which are applicable will also reduce, and therefore you have the benefit of continuing to make that investment at lower valuations and benefiting further over time.
Our next question comes in from Kishore, who writes in from Bangalore. He tells us he has a health insurance cover from his employee of 5 lakh rupees. And he wants to know if he should top up that existing employee cover for his family, or should he buy a separate family floater plan for safety for his family. Now, it does make sense, Kishore, that you get a policy that is independent of your employer's policy. That way, in case you change jobs at some point, it doesn't affect your health insurance. But, Anil, which one do you think makes more sense, a top-up of the existing cover or an independent family floater?
Sure, it's a very good question that you asked, because for employees who are covered under a group plan, the key issue is how do you ensure that there's continuity of health cover should you change your job or your employer. Now, to my mind, I think you have two options. One, obviously, you can have a high deductible insurance, which basically becomes applicable over and above your current insurance if you want a higher cover. But if you're looking for continuity, then I think a family floater option for yourself and your family works better, because you have a continued cover for the basic sum assured should you require it in the future. And circumstances changing over time will kind of ensure that you have a cover for the base, and beyond this, if you need to look at additional covers, then you can look at a top-up cover.
Right, our last question comes in from Shubhashish Roy, who writes in from Kolkata. He tells us he bought 2 term insurance plans from LIC and Kotak Life after watching this show. Well, that's a good idea, Shubhashish. He tells us now he has a total cover of 40 lakh rupees from his term plans and 15 lakh rupees from his employer. But before that, he had invested in the LIC Jeevan Saral and a child ULIP from LIC in 2009. Now, from what he says about his premiums, he's invested a total of about 60,000 rupees in both of these plans. He wants to know now that he has term insurance, should he discontinue the 2 ULIPs that he had bought earlier? And then what should he do?
Subhashish, between your employer-provided cover as well as the term plans that you have, I think overall, from a risk protection point of view, you are reasonably covered given your current salary income. So you have a clear option to continue with these policies because they are meeting your immediate requirements for risk protection. In the future, if you look at additional cover that you might require, then at that time I would suggest look at the online term plans also, because these term plans are fairly competitively priced and are well suited to meet your requirements. So you should be looking at continuing your current policies and look at additional covers as and when you require them. As far as your ULIPs are concerned, I think you need to continue with these, your ULIP and your traditional plan, because your surrender penalties will make the available amount to you fairly reduced in the event that you decide to move away from these. The systematic investments that you continue to make in these plans, you have to figure out whether these are well suited towards your additional requirements, and in the event that you require risk protection as well as investment cover. If you in the future require to save a lump sum, then you have the option again of the ULIP plans, or you could be looking at risk protection combined with other investment avenues such as mutual funds and so on.
Alright, that's a wrap on this show. Thanks for watching Investors Guide this week. Remember, if you have questions about your insurance policy, you can write to us on the email ID at the bottom of your screen. We'll ask Anil to answer your questions for you. Also, if you want to be profiled on our Diwali special show, you and your family, you can write to us on that email ID as well. You can also catch this show on our Facebook page. Tune in next week and catch Investors Guide. Thanks for watching.